And this chart is essentially showing us the average daily level of the VIX, which is the market's primary fear gauge from January through December across multiple cycles, regime crashes, and recoveries. The VIX, first of all, you need to understand that the VIX does not measure volatility that has already happened. The VIX measures expected volatility, what the options market believes is coming next. It is a pricing mechanism for fear, uncertainty, and convexity. When the VIX is low, the market is not calm, it is under pricing risk. When the VIX spikes, the market is not irrational, it is catching up. This distinction matters because seasonality in the VIX tells us when the market consistently underestimates risk and when it's forced to reprice reality. The gray line represents the historical average VIX dating back to 1990. Including and excluding extreme crisis years like 2008 and 2020. The red line, represents 2025 year to date, plotted against that historical backdrop. This comparison is devastatingly simple and deeply uncomfortable because despite new technologies, new narratives, new assets, and new paradigms, the shape of volatility has not changed. It rises early in the year, it compresses into the summer, and it explodes again in the fall, over and over again. So January through March is where optimism goes to die. This is the period when positioning resets and earnings reality collides, forward guidance and macro assumption face their first real stress test. The chart shows a consistent elevation in volatility in quarter one. Why? Because portfolios are repositioned aggressively. Because macro data surprises matter more early in the year. Because liquidity is thinner than investors believe. And because risk premiums are still being discovered. Notice how often volatility peaks around March or April. This is not accidental. This is structural. And something dangerous happens. Volatility falls. An investor mistakes this for stability. Look what happened towards July. By late spring and early summer, VIX compressed towards its annual lows. This is where leverage builds. This is where carry trades thrive. This is where selling volatility becomes free money. And this is where risk actually increases because protection is cheapest when you need it most. Right now, the cost of protection, the cost of buying a put, well, although today it went up, my position went up on my Patreon channel. I show that to my members, but basically my position went up 20% in one day, right? Where the market went down about 1%, 1.5% today. So history shows it clearly. Low VIX summers precede violent autumns. Now look at the right side of the chart. September, October, November is where volatility comes back with force. Fiscal deadlines, earnings reality, policy decision, liquidity withdrawal, risk repricing. Every major crisis in modern markets respect this calendar more than investors care to admit. That is when tail risk stops being theoretical. That is when protection stops being optional. Now let's take a look at the red line, right? So the black line is basically the 1990 to 2024, and the red line is 2025. It's not an anomalous, it's not extreme, it's not unprecedented, it's tracking history, which is exactly what this chart matters. The market believes it's navigating something new, But volatility is telling you this is familiar setup, different catalyst, same mechanics. Here's a core takeaway. Market consistently misprice volatility when it feels safest. And they overpay after it explodes. That is human nature. Seasonality is not about predicting the exact amount of the crisis. It is about understanding when the market is most likely wrong. Right now, the chart tells us one thing clearly. Complacency is seasonal. So is panic. Only preparation is timeless. Volatility is not your enemy. Ignoring it is. This chart is not a warning, it's a reminder. Markets do not change as much as people think. The only change who gets hurt. And seasonality always collects his debt.